Hey guys, you're listening to the Tascha Labs podcast, and today I want to talk about two things. First of all, I want to talk about this valuation model that I recently put out about how to value blockchain platforms. And I also want to talk about the impact of token supply, increase and decrease on valuation, on prices of platforms, of tokenized platforms. So these are related to the two articles that I put out recently, and I'm going to answer some questions about these today as well. Okay, so first of all, I recently put out this model using the data from 12 large blockchain platforms to look at how adoption and usage level is impacting the valuations of blockchains. So the idea is very simple. If you think about in any given point in time, what is actually determining the price of a blockchain's native tokens? Because by a blockchain's native token, what I mean is the token that is used to pay transaction fees on a blockchain platform that is publicly accessible, permissionless, and people can build stuff on top. Okay, so that is the type of setting. So you can think of it actually not just apply to blockchains, it can apply to any tokenized platform that has this kind of potential network effect built in. Okay, so if you look at it, like if you think about it, any given point in time, what is determining the valuation or the market cap of the entire, token supply of a platform? I think there are three main factors. One is adoption and usage of the blockchain itself. And second is what I call the platform moat. So basically, how secure and how lasting investors perceive this chain, this platform to be. How long do people think it's going to be around? So that's going to affect people's risk assessment, right? So if a chain is perceived as having a large moat, like Bitcoin is perceived as the digital gold, right? So at this point, it's already been around for, since 2008. So it has this intangible moat that is very hard to topple, right? So if you want to be another kind of if you make a copy of Bitcoin, and obviously people have done that multiple times, it's not going to have the same kind of valuation because people, because the users and the believers are on the original chain, right? So each platform will have a different level of moat that is going to affect how investors value the risk of the asset. So if you think about it in the traditional asset pricing kind of mentality or perspective, if an asset is perceived as more quote unquote risky, then investors gonna require a higher expected return in the future in order to invest in it, right? So that is going to have an impact on price. So that's the second factor. And the third factor is the total crypto market conditions. Because, like it or not, all the tokenized assets is a very small pond at this point. So everything pretty much moved together. There's relatively very little sector differentiation, or, no matter how you dice the whole pie of digital assets. So even if you think that this project is so special and unique and totally different from everything else, as long as it's traded on the same market, right? So it's as long as it's traded on Coinbase, on Kraken, on Binance, and whatnot, it's gonna be affected by the same kind of liquidity conditions and same set of investors, risk aversion levels, and so on and so forth, right? So crypto market conditions is going to have a huge effect on any valuation of any blockchain platforms. And so that's more in the short term, but in the long term also, the entire crypto market cap is like a kind of a proxy for, if you look at it from a more long-term perspective, it's a proxy of a adoption level of digital assets in general, right? So the more adoption, the more broad-based the digital asset adoption is, the more liquidity you're going to have in the market, the more potential buyers you have in the market, the more the easier for a platform to be discovered by. Basically, this is a proxy for the underlying audience base, how big a audience digital assets as a whole have, right? So that is what the total crypto market cap would actually capture. In the short term, is capturing, investors' risk aversion, is capturing market liquidity level is in the short term. In the long term, like if you look at step back, make one step back, it actually measures the adoption level of digital assets, the audience base, the potential buyer base, if you will, of digital assets as a whole. So if you put these things together, all right, then we can construct a empirical model to actually, look at how these three things affect valuations, affect market cap of different blockchains. So that's what I did. I used the data, mostly from Artemis. They did a lot of work to put these different blockchains, transaction numbers and active user numbers together, put them together in the long time series. So make my job so much easier to actually be able to do this. So this is basically what's called a panel regression model with fixed effect, if that's the kind of thing that you care about, but I assume most people don't. But in any case, you just you can just think of a chain's valuation as a function of chain's adoption level, which is proxied by active addresses numbers or transaction count, daily transaction numbers. Okay, and also a function of total crypto market cap and a function of the platform specific markup, if you will. That is one number that I use to measure the platform level moat that is different for different blockchains. So basically that is, this models the blockchain's valuation as a function of these three things. So how is this useful for investment, right? So the most obvious use case, if you have a model like this, you will have at any given point in time, if you know, this chain today has, 500K transactions, daily transactions. And total crypto market cap is, $800 billion. And the chain specific markup is, and then you can, from those data, you can deduce a predicted market cap according to the model. Once you estimate the model, right? So you can have a predicted market cap of that particular platform. Then you can compare it with the actual market cap currently, then that will give you a measure of whether this platform right now is undervalued, so to speak, or overvalued relative to its peers, right? So that is the immediate use case. You can think of, how to use a model like this. So I ran the regression, and again, this is based on data for 12 blockchains, right? So, but in the future, I'm gonna have a online tool for people to plug in the adoption and usage numbers of any blockchain they want, and they can get a predicted market cap out of that particular platform. So I'm looking to have this deployed maybe around the time of the new year. Hopefully, right? I'm working on it right now. So the result shows that so among the 12 blockchains that I looked at, right? So the ones that are shown as overvalued, so to speak, meaning the current valuation, the current market cap of the token is greater than the predicted market cap at this moment. Those are Polygon, Ethereum, BSC, and Flow. Okay. And the undervalued ones, meaning, because these are quite loaded words, so I'm kind of like hesitating to use these overvalued, undervalued, these words. I'll tell you why in a bit. But let's just say, I'll just tell you, like right now, according to the model, undervalued chains, undervalued tokens are near XRP, Avalanche, and Bitcoin. Okay. So, and the rest of them, the rest of the 12, what I have in the model, Optimism, Aptos, Algorand, Solana, they are kind of fall within, I would say the difference between the predicted and the actual market cap right now is less than 10% across, like whether you use transaction count or use active address to model adoption. So I consider these more or less aligned with so basically I consider those as the current value more or less aligned with the model prediction. So why do I hesitate to use these overvalued, undervalued, overvaluation, and undervaluation word? Because, on one hand, it's very easy, it's convenient because people know what these words are, and most people think they know what they mean. Okay, though I don't think most people actually, if you have a second thought about these, it's the meaning is actually quite tricky. But most people they think they understand what overvaluation or undervaluation means. So why I think these can be tricky, or these can be in some cases even misleading, because the financial market, you have a liquid market for whether it's stocks or the bonds and tokens. It's basically in the end of the day, what's determining the price is supply and demand. Okay, you can come up with any kind of model you want. You can say, okay, this stock, according to its future growth prospect, according to its profitability level, it should be $5 instead of $1. But if the market says it's $1 today, then it's $1. Okay, so there is so to say something is overvalued or undervalued, it's implying that there is somewhere, somehow, there is a neutral and objective truth about how much this thing is supposed to be worth, which, I just don't really buy into this concept. Okay, so but for the lack of better words, this is what I use. When the actual market cap is above the predicted value, I call them overvalued for now. So, but what it really measures, what the model really telling you, is that predicted value is how much investors would have been willing to pay for the thing, given historically. Okay, if we look at historical patterns, how much investors would have been willing to pay for the thing, given the current adoption level, being whatever level it is, and given the current market conditions. So that's what it is. Okay, so it's not to say, oh, this is a objective truth, because keep in mind, it's, for example, the model has taken into account the current crypto market conditions, which is hugely important, by the way. So if the crypto market today is worth $3 trillion, which is at some point in 2021, right? Then the valuations for each and every single platform going to be very different, going to be much higher, right? So, but that's in the nutshell. That's the result. But again, this is, you can think of the same model as applying to any tokenized platform that use some sort of transaction fee model, meaning users have to hold a certain amount of this token, this platform's native token, to use in order to be active on the platform. It can be used for transaction fees. That's the most common model. That's why I say, it can be used for any tokenized platform that use a native token to pay transaction fees, but it doesn't actually have to be that, right? As long as that native token is involved in the activity of the users on the platform, as long as you need that token to be used for something, then there should be a mechanical relationship, positive relationship between the adoption level, between the number of users and number of activities on the platform and the value of the tokens. And the reason is very simple, because you think of why do fiat currencies, why do fiat money have value, right? So I live in the United States. Nowadays, people don't use cash as much, but you still have checking account, right? You have like a debit card, which is if you pay using your debit card, you're drawing from your checking account, and your checking account balance better be positive. Otherwise, you cannot pay for things, right? So you have a daily transaction need. Therefore, you need to have quote unquote money in your wallet. So whether it's, maybe I need like a $20 bill in my wallet, so that just in case today I go out and get some groceries, I won't come back empty-handed, right? Because I need that liquid balance in my account, whether it's a physical balance or it's somewhere in my bank account, in order to pay for things. So in this economy, because this token or this money is used to pay for stuff, the more participants this economy has, the demand for that token just, mechanically increase. The same thing with the blockchain, right? So if you have a blockchain that has a native token that you need to use that token to pay for transaction fees, then you need to have some amount of that token in your wallet, right? So of course, you can, every time, it's possible that you have zero balance of that token in your wallet, and every time you have to do an activity on chain, you go to an exchange and buy some token, and then pay for the transaction fee. But if you are really an active user, that's kind of not very practical, right? So if you actually use Ethereum or you use Solana or any other blockchains, you have a liquid balance in your wallet to pay for stuff. If you're using the chain, right? If you're not an active user, then if you're just speculating on the token itself, that's a different case. But mechanically, the more users and more activities this blockchain has, it mechanically increases demand for that token, other things equal. Okay. So this is a very mechanical relationship. It has nothing to do with speculations or expectations of future prices. It has nothing to do with the cash flow, how much money this chain is pulling in today. So I'm going to talk about that. Okay, how is this kind of valuation model different from the cash flow based model? Because there are some questions that people have on that. So let's look at some questions. Okay. So first question from Novato Eve. Mind-boggling that you cover Aptos and not ICP. Okay. So and there are actually a lot of these similar questions. KC Doherty, could you post for DOT and ADA? So again, I use the data to run a model with 12 blockchains. Why do I use these 12 blockchains? Because that is the data that I have handy. That's the data I have readily available. Okay, so but it's the same kind of model. It can apply to all the other platforms that has a similar kind of mechanism. Again, I'm gonna have this tool ready that you can plug in the data. If you know the actual adoption level, the active users and transaction level of a blockchain, you can plug in a number and you can see the expected predicted valuation for the chain yourself. But I only posted these 12 because that's the database. Okay, so I don't have any bias against any of these chains, and also it's not because I'm favoring these 12. It's just because I can easily get the data on these. Okay, that's all. Next one from Sam. What is the predicted market cap and how is it calculated? Well, I just explained it. Okay, I'm not sure did this person actually read the article or not. No idea. Next one from Anna's Akkad. I think fees paid i.e. revenues, is a better metric to use over active users. Yeah, so this is what I mentioned, what I just talked about, right? So people, I know there are some people, they like to think of the token valuations as some kind of, discounted present values. So for transaction fees that this platform will have. Okay, so this is the kind of perspective that people traditionally use, especially the quote unquote value investors, will use to value equities, right? Because historically, when you're a shareholder of the company, what do you actually own? You're supposed to own all the future cash flow of the company, right? So then people deduce that, okay, so then the market cap of all the shares of the company should be the discounted cash flows of basically how much money this company can earn into the infinite future, right? So, but the problem of that in applying to Web3 platforms like blockchains is, there are a couple of things. Okay, first of all, the token holders are not shareholders. Okay, so I use Ethereum blockchain, and therefore I need Ether to pay for transactions. So I have some Ether in my wallet. Am I a shareholder of the Ethereum? No. Okay, so you can argue, okay, so what if the blockchain has some kind of model where it collects transaction fees, and then it uses that transaction fees to give like a staking rewards to stakers. So maybe stakers are kind of similar to a token to shareholders in the traditional equity sense. You could think of it that way. So again, I'm not like totally rejecting this kind of fee model, okay? But I'm just telling you, I think it's very, very limiting if you consider the blockchain platform's native tokens as some kind of equity. In most cases, for most people, to most users, they are not. Okay, instead of equities, well, they have some kind of equity component, especially if you are doing some kind of proof of staking or some kind of other type of incentive programs that is the platform specific. But I would much prefer to think of it as some kind of network effect driven. That's because that is fundamentally what's driving the demand. Okay, speculations aside, the fundamental drivers of demand is because people, when you actively use the chain, actively use the platform, you need to have some amount of that token. You need to hold some amount of token, and that is a very realistic and fundamental demand driver. And the price at the end of the day is just supply and demand. Okay, so that's why I prefer not to think of these blockchains as some valuations as some kind of discounted cash flows. Okay. Next one from Mr. Robot. Won't Avalanche experience high inflation in 2023? Okay, there are some questions, similar questions about this. Another one from my investing account. Those are undervalued because he's talking about the ones that I mentioned that are undervalued according to the model, which is near Ripple, XRP, Avalanche, and what's the other one? Bitcoin. Okay. And this person is saying because they have high inflation, but okay, so keep in mind, this model is predicting the market cap. Okay, it's not predicting price. So price is it's not exactly equal to market cap, right? Market cap is equal to price times quantity times the token supply. So yeah, so you can have higher token supply. It will have an impact on price, and I will talk about that in a minute, right? But this model is modeling market cap, okay? It's not modeling price. So whatever the supply effect, it's already being counted as part of the market cap. Okay. Next one. Back to fundamentals. Solana has a high percentage of its transactions as consensus transactions. So yeah, so the transaction count for Solana is already taken out the transactions that are voting transactions. So the transaction counts for Solana in the model is actually the actual utility transactions from actual users. Okay. The next one from Crypto Money Game. XRP has no ecosystem. Tokenomics is only in the hands of dev team. They holding XRP give you no rights. XRP worthy of 0. Okay. I have no opinion on XRP or Ripple. Okay. So again, this is the result that I put out is a empirical exercise. It's an empirical data estimate. Okay, it's not my own personal opinion. What I can tell you is, if you look at historically, the level of undervaluation or the level of overvaluation has a very strong inverse relationship with the relative performance of the token in the year after. So what it means, if today the model is showing, if today the model is the actual market cap is above the model predicted market cap, meaning overvaluation, then if you look at it like a year from now, very likely the token will underperform the market. Okay, underperform relative to the market, meaning relative to the total crypto market. Okay, so again, this is a historical pattern, and it's a very strong inverse correlation. So I will link the article. You can look at it yourself. Okay, again, this is not my personal opinion. All right. So now I know people would say, okay, like this person, particularly, he dislikes XRP or Ripple, and in other words, he thinks that quote unquote undervaluation is totally justified, and it's actually not undervaluation. Again, I don't have an opinion on that. Okay, maybe this person, maybe he's right. Is it possible that he's right? Yes. Is it statistically likely? No. According to the result, if you look at the historical correlation between overvaluation and the subsequent price performance of the token. Okay. So of course you can look at any one of these tokens and say, oh, this one is market cap is above predicted market cap. That's because it's getting so much momentum. It's because token supply is being burned, or it's because it's having so many big partnerships with X and Y Z companies that's gonna bring billions of new users to the platform. Fine. Okay? There's always a reason for something. Or you may think, okay, this current market cap of this token is lower than the predicted value. That's because this platform has shown no traction recently, and everybody knows it's going to die. By the way, not everybody, okay? Otherwise, the price would be 0 today. So, obviously, some people do not have the same opinion as you. So, but you know what I'm saying, right? Some people think that undervaluation is because the platform has no value, it's going to die. And overvaluation is because the platform has huge potential. But still, you cannot argue with the data that there is a inverse correlation, very strong inverse correlation between overvaluation and underperformance and performance in the subsequent year. So tokens that are undervalued today it performed relatively better in the following year. Token overvalued today will perform relatively worse compared to the total market. Okay. Now, obviously, maybe there is a survivorship bias here because we are talking about like these 12 chains. They obviously have already survived at least till today. So we're not taking it, we're not like in the data set, we don't have yet any blockchains that didn't survive. They just go puff, went out of business completely. Okay. So is that a possible scenario? Yes, it's possible. Okay. So maybe you can consider, okay, maybe that undervaluation is already taking into account the risk that this platform may go bust. Okay? That is possible. But still, you cannot, I just want to, again, emphasize this very strong negative correlation between overvaluation and subsequent underperformance. And by the way, if you are thinking, okay, maybe the undervaluation is because investors are pricing in the risk, the higher risk that a platform may go under, then I will argue that you remember at first we mentioned there is a third factor that is impacting the valuation, which is the platform specific markup that is supposed to measure the platform's moat or the perceived risk level, right? So if you look at it, so I posted this chart in the article, you can look at it yourself. The platform that have the highest markup are the bigger ones, Bitcoin and Ethereum, okay? Because they are perceived as more, why? So basically a higher markup, meaning at any given adoption level, okay? This chain A has 500K users, chain B has 500K users as well at the same point in time, but chain A, if it has perceived higher moat, it's more lindy, if you will, but for whatever reason, investors think it's safer, then its valuation will be higher, even given the same adoption level, same usage level. So which chains are those? They will have higher markups. Bitcoin and Ethereum have the highest because those are seen as the safest so far because they have survived the longest and people expect them to be around for a long time. Okay. So, and on the other hand, you look at which ones that has actually like a very low markup, the newer ones like Aptos and Optimism. These are like relatively new, haven't really had a really long track record, and who knows what's going to happen to them tomorrow, right? You can argue. These are already being discounted because of that. Okay, so the model is actually taking into account already that risk factor. So what I'm saying is there are a few chains that's still showing as undervaluation. And there are a few of chains showing overvaluation, even if you take into account these platform-specific markups. So all in all, I encourage you to look at this, article yourself, and you can think for yourself, okay? And the last question, W1 and Sama. The price already reflects how people currently value the assets. Basically, all undervalued coins that you listed are shit. And imagine saying Ripple is undervalued. Somehow, just like people really dislike XRP. Again, I'm glad that people have different opinions in the market. That makes the market, right? Otherwise, price... if everybody all has the same opinion, price will go to infinity or go to zero all at once, immediately. So, but in any case, this is something that I already talked about so far, right? How these undervaluation and overvaluation actually calculated and what they actually reflect. Okay, so that's that. Next, let's talk about token supply. So basically, I put out another article also recently, like a couple weeks ago. So I looked at over the past 3 years since 2020. I looked at the top 1,000 market cap tokens and how much their supply has changed and how much their price has changed. So I look at this on a annual basis. So it's very, very simple exercise. It's just look at how much this token has supply increased in 2021 and 2022 and how much price has changed in the same time, right? And very intuitively, as you can imagine, there is a negative correlation between the two. So if the token supply increased, it puts a downward pressure on price, right? That's not that interesting. You probably imagine that. What is interesting to me though is that the impact on price is not 1-to-1. Okay, so that means for example, if the token supply increased 30%, its price impact is 15%. You only see on average 15% price drop, because that's basically the basic result is that 10% token supply change leads to 5% price change. This is quite interesting, at least to me. All right, why is it interesting? Because the token supply change has nothing to do with the chain's fundamentals, right? So it's just, if Ethereum today has 100 million tokens, tomorrow it becomes 200 million tokens, it's still the same platform, right? Still the same bunch of people using it. It has the still same amount of traction. But the model is saying if tomorrow the token supply doubles, price drop will only be half of that. So in other words, it will actually lead to an increase of the total market cap of that token. So I find that really interesting. There is a similar phenomenon in the stock market, which is the effect of stock split, right? So if a stock splits its stock into, if you sometimes people when companies when they're usually it's when stock price gets to a higher range, then the company split their stocks. So yesterday you own one stock, and today you own two because it has because the company did a 1-for-2 split. So that kind of thing. It actually, a lot of times, it has a similar effect as the one that I just mentioned. If you split the stock, from 1 to 2, it actually leads to a market cap increase of that stock. So, in other words, you would think that if one stock today becomes 2 tomorrow, the price should be cut by half, right? But the price will be cut, but it's actually less than half. So why is that? So a lot of people say, okay, there may be a liquidity effect, because if something is lower priced, it, kind of entry barrier of buying that is lower, so to speak. Though you can argue, well, why is that? Because it's not like you can only buy a whole token, right? You can buy 0.5. If you cannot afford one Bitcoin, you can afford 0.00001. So you can just buy however many you can afford, right? But in fact, that is actually not true, because it's just a weird psychological effect that people, lower priced tokens or stocks, they're just more popular. People think they're more affordable. So people are more willing to buy those compared to higher priced stocks or higher priced tokens. In the stock market, you look at this, it's the same thing. Higher priced stocks tend to have lower trading volume and lower liquidity. It's not always true, but it's a tendency. Okay. So you can say, yeah. So because when you lower the price, when you increase supply, you lower the price, and that leads to more buyers, more potential interest, and that increases the liquidity of the market. So it kind of there is an additional liquidity premium to the price. Okay, so that could be one reason. I don't think that's the entire reason. Where does the rest of this come from? I seriously don't know. But that's what the data shows. Okay, so basically that is the effect. And then still it depends on, so that is the general effect, but it depends on what situations we're talking about. For example, if we're talking about a supply reduction, it has actually a stronger effect. So let's say if a 10% token supply increase will lead to 5% price drop. Token supply dropping by 10% will actually lead to more than 5% price increase. So that so supply reduction is actually stronger impact on price. Okay. And also the supply has more impact on price in bear market because, I think this is quite intuitive because the underlying liquidity in bear market is already lower, and investor base is already more risk averse, and the underlying demand condition is already worse compared to the bull market, right? So all of those has a impact on, the degree of effect of token supply on price. And then one thing is also quite interesting is that the effect is the same. So the relationship between supply, change, and price is the same whether this token has a max supply cap or not. In other words, whether that token has announced, okay, we're going to have 100 million tokens from now till eternity, whether it's that or whether it's like a utility token with supplies, increases over time as the platform grows. It does not matter. I know this will surprise some people because the typical crypto investors love a fixed supply cap because that means somehow they're not being diluted. That's the way people think about it. But if you actually look at the data, but that does not mean in the short term. When you have a max cap, we're talking about like at the end of time cap, right? But it does not mean that in the short term the supply cannot increase or decrease, right? So in the short term you still have a disbursement schedule of that whatever token that is, and you can still increase the supply, and that has the same effect whether that token has a max supply cap or not. So I find that very interesting. So this mechanism is the same regardless of the supply cap, and I'm actually gonna write more about this later because I'm working on something to look at this the impact of having this max supply cap on tokenomics, because I actually don't think it's a good idea for most of the smart contract blockchains or Web3 platform, unless you want to be a digital gold like Bitcoin. If you have a utility token, if you have any kind of platform network effect that's actually growing, your user base is, in the foreseeable future is going to continue to grow, fixed supply cap is not a good idea. And I will say more about that in maybe the next episode, okay? Maybe in the next article. Okay, so that is that. And let's look at some questions. First question from Look First. This does not factor in millions of tokens that cannot be retrieved because private keys lost forever. So so he's talking about like the supply, token supply is not a good measure. But unless you think the supply key lost factor, like a private key lost, basically tokens cannot be retrieved, unless you think this is kind of ongoing systemic factor that is going to affect the supply on an ongoing basis, not just a one-off thing, okay? Unless you think that's going to have an ongoing change, it's going to have an impact on an ongoing impact on token supply. Otherwise, it's not going to be something that has a systemic effect on the model. Next question from Jay. NFTs have the same price mechanisms regarding token supply versus price. I would not be surprised if that has the same mechanism, because like I said, you can see the similar phenomena in stocks as well. I'm sure in other assets you can probably see something similar. Okay, in other things that are relatively liquid. In NFTs, I think it's harder to measure because it's less liquid, and also a NFT project usually, most of these NFT projects, they have one-time minting and that's it, right? So it would be pretty hard to collect data on that. But I would not be surprised if there is a similar kind of mechanism going on. Okay, next question from Decrypt Sim. At this point, no one cares. Crypto is over. 14 years of cheap liquidity gone, as is crypto. This is not like past bear markets. Policies have fundamentally changed. They will affect the decade ahead of how assets are priced. Okay, fine. If really no one cares, again, if really indeed no one cares, every token price will go to zero right now. Okay. The fact that they're not means somebody cares. Maybe not you, all right? Obviously not you, because you're saying you don't care. Oh my God. Yeah, sure. Is the policy change pretty fundamental? Probably gonna be for a while. Okay, is the cheap liquidity gone? Yeah, yes, gonna be for a while. Is it gonna be forever? I don't think so. And is this? I don't want to go too much into this because we're not talking. This is not an episode about macro conditions right now. Okay, but the nutshell is, in the short term, is crypto prices hugely affected by Fed policies and monetary policy conditions? Yes, obviously. I've talked about this many times. However, it's still, we are only at the very beginning. We're talking about like 800 million market cap of entire tokenized asset universe for the fungible tokens. Okay. It's really very small. We are at the beginning of what I consider a huge revolution that is called tokenization, that is going to change a lot of business models in the world. It's going to change how the businesses make money and how people make money, and it's going to change the shareholder and company relationships. It's going to change value distributions in society and how company revenues and profits being distributed, a bunch of things, and so on and so forth. All of these are fundamental, tectonic shifts that's going to take a long time to play out. And that cycle, what I consider, is more like a decade-long cycle. We're talking about 10 years, 20 years, 30 years, okay? The monetary policy cycle is relatively, it's much shorter than that. So yeah, in the short term, it's going to affect things for sure. Does that mean crypto is dead? No, not at all. Okay. Next question from, but of course, if you think the crypto is dead, it's totally, I respect your view, right? It's your money, you put wherever you want to put it. That's your freedom. It's a free world. You can do anything you want. Next question from Ignace. I wonder if this research takes into account veTokenomics. In vToken model, token supply increase is given as a reward to LPs. Yeah, I mean, in the article that I mentioned, so the veTokenomics, or it's just a way, it's just like one of the ways that a project encourage people to hold tokens, right? So you like a proof of stake blockchains have staking. That's another like you can think of a mechanism for people. It's not a whole purpose for have staking, but it's like at least indirect purpose. What it accomplishes is like encourage people to hold tokens by receiving rewards, right? So it's like an interest payment, if you will. I already mentioned in the article, it's actually if projects from a project point of view, if you think about if you know this relationship generally holds true, meaning if you increase 10% of your token supply, price will absorb that. If the price impact will be half of it. So that means you can use that token supply. You can continue emitting tokens, provided that you have a healthy, growing platform. Okay, I'm not talking about the Venezuela or Argentina scenario where you just print money to oblivion. All right, what I'm talking about is that you can strategically increase your token supply as a way to provide incentives to new users, to attract new users to the platform by giving incentives, right? That's what platforms do. Many of them. But on the other hand, you don't have to at least outrightly hurt your existing token holders by doing that, because you could increase token supply by 10% and give 5% to your existing token holders, whether it's like a veToken model or staking model or whatever. Basically give long-term holders, people essentially believe in your projects, a reward. So give people, if you increase token supply, half of it, give it to your existing stakeholders, and half of it use as an incentive to encourage new people to use your platform. So in that way, your existing holders, they're not made worse, so to speak. At least that impact is kind of mitigated to a large extent, right? So yeah. I wonder, next question from Adam P. I wonder if we can split into various categories: lending versus vaults versus Yeah, you could, but I mean, we only have we're talking about like a top 1,000 token with market cap top 1,000 tokens, and actually it's not 1,000, it's only like 700 or something, because some tokens are too new, they don't have entire history of 3 years. You could, but we have kind of limited data on that. Abhishek asks, I wonder how the supply shrinkage affects price in bull versus bear market. I didn't look at that, but my guess is that supply shrinkage will have less of effect in bear market in boosting token price, for the same reason that we just talked about, because liquidity is lower, fundamental demand factor is lower, and everything is lower. Okay, my guess is it will have less of effect, but I didn't look at it. And also, the kind of a supply shrinkage effect is harder to look at it because the sample size is much smaller, because most of the tokens have increasing supply, not decreasing supply. Okay, so it's a very small pool of tokens that has decreased the supply. So that estimate result will be less reliable, all right, because of small samples. All right, that's all for today. I will talk to you next time.